Hi everyone, and welcome to this new episode of ThinkMacro. Today, I we will discuss with Thomas Delabre, portfolio manager at H2O Asset Management, and expert on the emerging market, on the mid-year outlook. A lot has happened so far, so we will discuss the next 6 months and more on the economy. Hello, Thomas.
Hello, Vincent.
So far this year, we thought at the beginning of the year, when discussing this year's outlook, that Europe would resist, Asia would perform, and the US was surprisingly resilient. And together with this resilience, we had in mind some fragilities that were appearing in the US economy, and we thought, okay, that may take the economy down and make it slow down over the course of 2026. Now, a lot has happened since we had two major shocks to the world economy. A shock that comes from Middle East that took oil prices up, so not the shock in itself, but the closure of the Strait of Hormuz had a huge impact on oil prices and energy prices in general, and that's a new inflation shock that comes on top of tariffs last year. And more recently, we have a third inflation layer shock with artificial intelligence, the boom of investment you have on AI that drives the price of components up as well. So the big question we have from a macro standpoint today is how this triple inflation shock can impact the world, can impact these three regions we discussed last time, with very different outcomes, very different reactions between Europe, the US, and Asia. So let's start with Europe. So Europe looks fairly straightforward. Is the European low risk, low return model. Europe has got plenty of savings, which are in essence a buffer against any shock and are a buffer against the current shock. But also Europe has very few means to sort of counterbalance this shock, and you end up with a European continent that seems to take the shock at face value. Growth was expected to be fairly good by European standard, say 1.5%. We thought at the turn of the year is going to be half that, roughly speaking, because of the shock, with very few mitigation measures. Now, a bit maybe more surprising was the reaction of the central bank that, consistent with its inflation mandate, has decided to hike rates and communicates in a fairly hard way on future hikes, fighting inflation, and committing to really making sure that there's no second round effect in Europe.
Yes, indeed. Hi. Hello, Vincent. Indeed. I mean, Europe is Europe. There's a lack of sexiness from a macro standpoint in Europe, as we know, on the downside, on the upside. I think what you mentioned and what is important to say here is that Europe is entering that oil shock in a very different situation than it was the case in 2022, where inflation was fairly strong.
So quite different from what the central bank says, right? It is different than 2022.
Yeah, this is different, but from our reading, indeed, the reaction function of the central bank should be slightly different than it was the case, and the ECB should not enter into a long tightening cycle as it was the case in 2022, as the Fed was, by the way. So the ECB hiked last week, we know, by 25 basis points. The market is still pricing around 30 basis points by the end of the year, and even more so next year. So what is important for us in reading that shock is that, of course, it's inflationary, but second, to the second order, this is recessionary for the economy, for the purchasing power, by eroding, the purchasing power of consumers. And so from that standpoint, the central bank should not be overreacting to that move. They did. I guess part of their mandate, inflation targeting, they had to react for the confidence of the market in their mandate, in the credibility, even though, but so far, we don't see much, second round effect on salaries and wages
And
in Europe.
maybe we could add the fiscal side, right? Back in 2022, you had a lot of fiscal injections, so measures to mitigate the shock of the Ukraine war. It's not the case today. So that also should sort of reduce the risk of potential second round effects.
Yeah, indeed. There are a string of factors, as you mentioned. The wages, it's very important for, of course, the central bank to see if you do have a spike in wages, that means that, anticipation, expectation of inflation might be disencored. And from our point of view, this is very unlikely to happen. So eventually, the expectation of the market in terms of the pricing of the ECB cycle seems to be overdone in our position.
The market's pricing too much, yeah.
The market is pricing too much. So from that standpoint, it was a good strategy in that crisis we witnessed over the past 2 months, and the repricing of the ECB hikes to counter that and to buy some short-term bonds in Europe. And it's also multi-scenario from that standpoint if things are getting worse.
Yeah, and there's also, part of the job of the ECB. It's an inflation mandate. They have to act on that basis. They have to communicate hard. And in doing so, they actually, because they do it well and they are successful in this communication exercise, they actually reduce the risk of second round effects and make it even more recessionary than the shock itself. So they actually go our way, the way of that ends up being positive for bonds, European bonds. And in our portfolios, that's the conclusion we do draw today on European assets. It's first inflationary, but temporarily. Right after, it is recessionary. Growth is going to come down. And too many hikes are priced for that scenario that comes next. So there's a strong opportunity on short-dated European bonds today. And the good news is that it offers also a decent protection for our portfolios for other positions we may have elsewhere. So let's move to the US, which has a fairly more speculative way to leverage itself out of the shock. So in a fairly American way, they are facing a shock, probably even bigger than the shock Europe is facing at face value. But they sort of refuse the shock and double down with massive AI investments that so far, to be fair, do offset the shock. They maintain growth in spite of tariffs. That was the surprise we had last year by the end of the year of still decent growth in spite of tariffs. Today, it's still decent growth in spite of the triple inflation shock and oil and AI coming now. So the question I think we may discuss today is what's the ability of the US economy to counterbalance that shock, for how long, by how much, and can they really leverage their way out of that inflation shock? Just to start with a number, the revenue squeeze US households are facing, it's 80% of the economy consumption. So that's important for the US economy. Today, inflation is running, that's the last number from May, on an annualized basis, is running above 8%, headline CPI. Against that, salaries are more like 3.5%, if not a bit less. And aggregate labor income on aggregate is slightly above 4%. So that's big. That is something we haven't seen outside of recession, and such a drag on real revenue. Of course, it's only a month so far. But if we are to say it's not going to be easy to take oil prices back down to $60, it's going to take time. If we are to say inflation coming from AI, it's demand-driven. Companies are here to invest and they won't stop tomorrow. It's likely that this inflationary pressure persists for some time. So are we not, at the beginning of some very severe pressure on the US consumer that could take the economy down?
Yeah, well, it's not only the beginning, to be honest. If you look at the dynamic of this real income in the US, it's been coming down for quite a while now, not only in this crisis.
You mean the consumption component?
Consumption
Yes,
and the real
yeah.
income in the US has been coming down for quite a while. Inflation is quite sticky eventually, even though it came down from the peak in 2022. There is, a spike at the moment that might be coming down a bit if the oil price is normalizing. What is important here is that you do have some inertia in inflation because you have a triple shock, as you mentioned, the tariff, the software and the IT or the AI, the inflation linked to AI, and then the oil prices. So all those shocks will roll down in a way. This is the case for the tariff shock at the moment, but the inertia is still coming in. And we haven't seen any reaction from the salary standpoint. Okay, so from that standpoint, real income has come down for quite a while in the US. And this is a question, as you mentioned, it's 80% of the GDP in the US consumption. So you need a strong consumption to have a very strong US growth. And to put things into perspective, and I think it's important because there is some perception that, the US economy, if you were looking just at, let's say, the equity market and the investment in AI that has been announced over the past 6 to 12 months, you had the impression that you are back into the 2000 where growth was riding at 4 to 5% on an annual basis. We are around 2, 1.5, 1.6 in the first quarter, maybe 2, maybe slightly above 2, which is close to par on the potential growth. And when you look at the share of investment in AI in that growth, it's fairly modest for so far. The direct impact is 0.3 to 0.5% of GDP out of the 1.5 to the 2% we have. So it might be increasing, but this is not the bulk of the investment because consumption is still subdued and there is no driver coming out of consumption at the moment. What is important to notice as well is that this is also a drag on the headline growth because a lot of this investment is imported, from Asia. So it has a net negative impact on the GDP growth.
But I mean, now if I may, Thomas, consumption has been surprisingly resilient. I mean, to be honest, yes, it's been coming down as a trend over the last 3 years, but yet recently you can see that the US consumer in the last 6 months has consumed well beyond his revenues. Revenues are coming down, yet he's still consuming at a similar pace. You can see that slope of revenues coming down, right? But spending is remarkably constant, if not actually going up today. I would link that to the confidence derived from the theme. So yes, AI is small. The physical contribution, as you said, to GDP is fairly small, at 0.3, maybe 0.5% of extra GDP last year and this year. But the confidence it brings in the system through feel-good factor or feel-strong factor, as well as wealth effect from the stock market. We know US consumers are well exposed to this confidence that comes from these factors led to well above revenue consumption and healthy economy. So of course that means savings continue to come down. But I guess the big question is how long can that persist? Because by nature it isn't sustainable. You cannot tap into your savings for too long, right?
Yeah, well, it's a difficult question, and I don't have the answer. I think our role here in the way we are analyzing the macro and the markets, what we can point out to our listeners is that you have a string of markers at the moment in the macro and the financial variable in the US, which are, pointing out to signs of kind of weakening in that this stage
fragilities,
is getting less and less steady and stable, okay? And that's something can break. And as you mentioned, the confidence is very strong in the stock market, and this is helping reducing a consumer tapping in the saving to consume even more despite and to face
not saving
the
anymore.
shock. They're not saving anymore, or very, very few. And so they're tapping in their saving to face, the different inflationary shocks. you had some, fiscal impulse thanks to the OBB in the US. Lately, it was $140 billion at the moment of the Strait of Hormuz closure. So it's in an important flows into the US consumer pocket that helped buffered that rise in the oil price at the gas station. But I guess the question here, and this is important for us to mention, that yes, this state is getting more and more fragile. We don't know when, this can be turning from one side to another of the cliff, but clearly we have those, the box ticked that we are more careful.
I mean, to be fair, you're right. I mean, the impact of the OBB is actually now fading, if not over. It was all until end of May, early June. So as we speak today, there's no more positive impact to be expected from that side. So on the fiscal side, there's no more support. We may argue as well that due to these shocks, the Fed will not be easily present. It will not easily come to the rescue. Hard for them to cut rates in the current context, so it's going to take a while before they're back on the on that side of the equation. As for savings, there's nothing left in the pocket now. The private sector, you may argue, was very strong in the US with all these companies that had made huge profits on the tech sector worldwide, and that are now spending this money. So probably constitute a stimulus to the US economy from the private sector. All these hundreds of billions, the big five, the so-called big five, are now spending to build these data centers. That's huge money. That's similar to a support, a fiscal support to the US economy, is it not? You may argue that could suffice to leverage the economy out of the shock.
It may, entertain the movement or the cycle for quite a while. Then the first question we can ask about this cycle is that, as I said before, a large part of those investments are directed to Asia, imported from Asia. So the main beneficiary, first order, is Asian producers, Taiwan, Korea, and so on. We'll talk about it later. So that's an important thing. The second thing is that there is a rise, in investment in AI this year, but a part of it is just nominal illusion in the sense that the prices of the inputs for the data center, the chips and so on, has increased.
You mean costs are rising?
The costs have risen quite a lot. So from that standpoint, that if you look at just at the nominal amount of total investment, which let's say might be 800 billion or maybe more, about 25 to 30%, if we cross-check the numbers with, the exports from Asia, are coming from the rise in prices. So the net, I would say the real, rise in investment is slightly lower than nominal investment. So from a macro standpoint, it matters because first, the rise in prices is going to Asia, is going to Asian producers and not to American producers. So that's the first thing. So on the steadiness, the durability of that cycle, the question we have is a question, as I think a lot of people have, is that the circularity of this ecosystem, in AI. So it's investment in a company owned by another company within an ecosystem, and 80 to 85% of this investment is circular, is generating revenues and profit.
Remains endogenous,
Endogenous. So the question we have is that at some point, is that, it might be indeed put into question by investors.
They're building a new product, but so far it's mostly the staff buying. There's no big final consumer buying these AI products, or at least we're all using it, but not paying much for it. So, indeed, when you look into the number, crunching the numbers, most of it remains within the system. And something I find interesting and possibly worrying on the ability of these companies to monetize under the whole thing, that these massive investments they have, and these $800 billion for this year, on above the sort of 500 we had last year, up to maybe 1 trillion next. Is that these 85% you mentioned, 85% of internal money circulating within the system is fairly stable. I mean, it's been there for about 3 years. There's no positive dynamics. In such a revolution, you would have expected the ability to sell it to the outside world to increase, not to remain stable. And that sort of hints at really difficulties to monetize that AI production, AI engine they are producing out there. Now, possibly there's more hurdles to it today. You can see as well there are bottlenecks in the ability to build these data centers, and price of electricity, of water, the authorizations they need to build these centers. You mentioned the cost increase, which makes it for the big part of the increase in these capex numbers. It's essentially cost driven. You may mention as well competition. In this big AI revolution, the business plan is drastically changing for the US companies. They're moving from a low-cost, monopolistic business plan. And when you sell web advertising or social networks, it doesn't cost you much, and you are pretty much in a monopoly. You don't change the social network that easily. AI is a completely different animal. You need to spend a lot more, 100 times more, for something that is highly competitive and also interchangeable. You can change AI engine fairly easily. I guess we've all changed already a few times over the last couple of years. So that shows the difficulty for these companies to keep these margins. They will really struggle in this highly competitive world. First, to monetize these huge costs, but also over time to keep it. It's one thing to come first to the race, but staying ahead of others is going to be difficult in the context of high competition. Just one example there. I mean, the DeepSeek engine that shaked markets last year is not far behind in terms of efficacy for the user. You talk in 20-30% maybe less efficient than the big US engines. Now, it's also 20 to 50 times cheaper, depending on the request you have. So you already have competition in there. So you're already in a world where these companies will struggle. In short, the way we could see that big AI investment boom, the US is putting huge money on the table today with a big bet on the future. But today, it benefits Asia. Now, will it benefit the US in the future, and in how many years are major questions. And from a macro standpoint, the answer is not obvious, far from it.
Well, I think the most obvious answer is that it will benefit to the US, of course, but it will benefit if the outcome is as strong as expected. It will benefit consumers across the globe. So at the end of the day, as it was the case with the web, so from our standpoint and on analysis, it's better to be, positioned to the recipients of those investments, the providers, and the consumer eventually would, and it's true in Europe.
The two extremes of the chain,
exactly.
The production chain.
So that's a key point. I think to add up to the listing of concern that we may have, is that we are, turning at a tipping point where we see more and more leverage coming. So they have to borrow, they have to come to the market, they have to borrow to build data centers and so on. We know that now the cash flows are not enough to finance the investment. So you are entering a phase of the American usual leverage cycle, which is a classic. Maybe it's a beginning, maybe it's mature. Of course, indeed, the leverage so far has been quite
fairly
low, fairly limited in the US, and we've explained that many times. Is that because during COVID, the state balance sheet, the fiscal, the sovereign, has taken on the private balance sheet, whether it's the consumer or the corporate. So we started the cycle in a very healthy situation. But we start things that. So that means that then you're going to be more sensitive to rate hikes, to the interest rate, and so on, and to bad loan and so on. So we're not saying that we are in a bottleneck at the moment from a leverage standpoint, but the financing will become an issue as well from the standpoint.
Yeah, we might end up with an overhang of debt and equity and supply of of capital there in AI. In the end, I mean, the US, in essence, is financing a big tech revolution to the benefits of Asia today and the rest of the world tomorrow. In the meantime, they do bear the huge cost and the big risks that do lie ahead. So that's not a win. The win should not be taken for granted there. Now on assets, that tells us, maybe to conclude on this US part, that we remain very cautious on US equities for all the reasons we just described. And from a macro standpoint, it is really challenging there. We continue to step away from treasuries, so from bonds where it's going to be difficult for the Fed to cut rates before it really slows down. And long bonds continue to be basically sold by investors, and they do move away from these bonds that they see as riskier because of inflation, because of solvency, and because of the credibility of the U.S. central bank. So we'll also sort of move away from this part of the asset spectrum, and of course the dollar. The dollar, as a consequence of assets, the dollar that has shown that is probably now linked to assets that are more volatile, riskier, less rewarding as well than in the past. And the dollar, more recently, because of what happened in the Middle East, that has probably shown that it has lost some of its protection qualities, its defensive, safe haven attractiveness it had in the past. So it's basically out of everything US related in our portfolios today, probably even more than was the case at the turn of the year. Now, maybe on a more positive note is Asia. Asia, less speculative, more realized, and there you're more the expert here on the region. It seems at face value that not only does Asia has the means to absorb the shock with more savings, better ability to absorb it through fiscal measures than the US and even Europe, and that Asia benefits from a strong macro dynamic because it's an immediate it immediately benefits from the AI investment boom in proportions unseen in Asian history. And I would even add that from what we see, that they are quite good at sort of redistributing the gains of this AI boom into the rest of the economy. So it's not to the benefit of a few happy stakeholders. It's really through fiscal measures, through bonuses in companies. It seems that Asia is really doing a good job in translating these profits into real organic growth in the region.
Yeah, indeed. I mean, when you look at Asia at the moment, clearly this is the main beneficiary. And, to contrast with the US, and you mentioned about the monetization of those investments in the US at the moment, Asia is monetizing on day one because they are selling product and they are paid, and they are not only paid on day one, but they are paid forwards because they are their orders are full. So from that standpoint, this is real money coming in with investment they've made. They have to make more investment in the future. But so it has direct consequences on the macro side from the Asian point of view, on growth, on investment, on consumption. And just anecdotally, we've seen that in the first quarter, Taiwan was running, an annual rate of 14%, 1.4 GDP growth.
Wow, yeah.
Of course, it might be, surely it will normalize in the coming quarter, the coming years, because there was initial boom of orders from the US. But we can bet on the fact that because this AI revolution is here to last, this is not our purpose here, will continue. And so far, Asia has not been challenged in terms of, being the main input in that.
The main provider.
The main provider in that chain. So the macro consequences is important. And it's even more so from a flow standpoint. When you look at the dynamic of flows, of course, this is resulting in large current account surpluses because the U.S. companies are buying products from Asia and they buy in dollars, and those dollars are returning to Asia in the form of trade surpluses, and so there is a flow of dollars coming into Asia, and which is flowing back into the US at the moment in form of investment.
Yeah, so far it's being recycled into the US.
So far it's been fully recycled, and that explains why those currencies have been quite weak against the dollar, because the money which was flowing in was returning to the US.
It's a bit like the petrodollars, right? It's
exactly what happened with the petrodollars in the years 2000, and it's even bigger than in terms of amount and volume. At the moment, it's even bigger than this was at the time, because if you add up for the current data you have in Taiwan, in Korea, and in Japan, if you add up all the current account surpluses of those three countries and running them for an annualized basis, you're around $500 billion. So those $500 billion are mostly recycled.
Yeah, that mirrors the spending from the US almost.
Exactly. So the US benefits in a way indirectly because this is sent back in the form of of investment in treasuries, in US equities. Treasuries is mostly for Taiwan, and US equities mainly for Korean. And so far they've been buying this story. What we think will happen is that the balance of flows at the margin, or even more so, maybe more structurally, will shift a bit. That is that more of those dollars, what we may call the cheap dollars, the cheap dollars will be recycled more locally in terms of investment, i.e. what you're going to face is Samsung investing into new plants, TSMC in Taiwan, new plants in Taiwan and in Korea to produce more chips and to invest in R&D and so on and so on. So you will have that's natural move. You will have part of it which will be spent locally in local, consumption by employees having, nice salaries and good wages, and probably investors will invest more and more locally in their local equity market or bond market.
But maybe one point on this, Thomas. I'm a bit surprised to hear you saying that their plan is to invest these big companies to recycle a lot of this money locally, because what we see so far, I would say, is probably the opposite. I mean, if you look at the nominal v real exports from Asia, most is in the price. They are not producing more, or not much more, in front of this high demand from the US. They're just selling at a higher price. So basically, they are raising margins, which I find is a very strong approach, because basically they are avoiding the risk of overproduction and overcapacity in the future. Essentially saying, okay, there's a boom today, but it may not last. So we refuse, as Asian factories, Asian providers, to bear that overcapacity risk. You even had some Taiwanese and Korean companies saying, if you are to want to get that production faster from as a US client, then you pay for the next 3, 4, 5 years. You finance the whole thing, and then then we can produce more. But that's in your hands, and in that sense, it makes, in my view, even more speculative from the US standpoint, that bears the whole risk of the whole project, when Asia just leaves that in the hands of the US.
Yeah, probably from a business standpoint, you're right. But of course, I mean, part of that money will be reinvested locally into new capacities and R&D to
one way or the other,
be ahead of the game. I'm not saying the full amount, and maybe they want to regulate. I'm here, if from a macro standpoint, I think what matters, because we've been studying a bit, into details, the dynamic of flows. And it's true that so far those currencies have been weak, because I think the local authorities, like the Japanese authorities, were not that unhappy with the weak currency, because, you gain competitiveness. Where, it's becoming a bit more tricky for local authorities like central banks is that you have imported inflation, which is, there is the oil price increase, but when you have a weak currency, you pay even more.
Help,
so you have imported inflation, so that's an issue, and imported inflation is rising. You do have also an issue with the fact that because investment and domestic demand is supported by strong growth, unlike in the US domestic demand, well, you have pressure on wages. And this is, when we talk about Europe and the US, here you have risk of second round effect in Asia, which are very strong.
Different from what you see in Europe.
Here you
even different from what you see in the US, indeed.
Exactly. Yeah. So here you have to react, and by being more hawkish and to tighten monetary policy, and you have fiscal flows because corporate taxes, VAT is flowing. From that standpoint, I would say the whole spectrum ecosystem of the policy mix, as we say, monetary policy and fiscal policy, is benefiting from that.
Yeah, you really have that distribution into the whole economy of the benefits of the investment boom, really. I mean,
exactly.
What you described.
And that matters a lot from our point of view. And, when if you put the two blocks, you have the sender, which is Asia, the saver, and the recipients, which is the US. Here you have more and more demand. You need to finance more AI investment. So you need a bull market in the bond market, in the equity market with new listing and so on. You need fiscal, and fiscal is not about to be tightened anytime soon. So you need new financing to finance the fiscal deficit coming in from local investors and from Asia. So this saving is financing the US at the moment. The problem from the recipient's point of view, and this is what we've described for quite a while, is that the question is getting weaker. From standpoint, it's still there, the question, and the machine is still working, but the state, from our point of view, is, I would say, less
appealing.
Less attractive, because the fiscal deficit.
So far, Asian money is really invested in US assets, really financing the deficits and the needs of money you have out there. But I guess your point is about the fragility of all that and questions being asked from an investment standpoint. There's a point where Asian investors may question the appeal of these investments from a risk standpoint, maybe for the reasons we discussed about the US, or from a return standpoint, if really they struggle to monetize.
It's just a question of risk reward, as you mentioned. And as we have increasing needs in the US, you need more marginal buyers. It's not about the static, flow of money.
That's true. Yeah,
about $100 billion going from Asia to the US every year. You need more to go because you need more financing for AI and you need more financing for the state. So as a recipient of those flows, you need to be more attractive. From our standpoint, the US is getting less attractive on many points. So we think that part of this money, at the margin, or it might be big amount, so you need more, is going to be less and less invested in the US and more locally, and it will be invested in the domestic market, equity market, or in local investment. We've seen lately that the Korean authorities have enticed the National Pension Fund to invest more in the domestic market,
which is a strong signal. Yeah,
it's a strong signal. I think it's probably a phenomenon that we're going to see a bit worldwide, because domestic financing needs in Europe, in the Middle East now are increasing.
Rising everywhere.
So they need to invest locally. So it's a question of sovereign, risk independence, I guess, as well. So we need to understand that we don't need a sudden stop in flows from Asia to the US or to the rest of the world, mainly to the US. To revert that dynamic, you need to have less and less
marginal change in the recycling process.
Exactly.
If they just stop investing 100% of their money into the US, just takes that down to 90.
Exactly.
It's already a lot, and it's already very supportive for local assets and local currencies. And indeed, I take your point about that sort of global move, really. The whole world now is in a position where both it's getting skeptical about US assets and the underlying risks, and maybe also on the protection they used to offer, the dollar particularly, as well as in need of more money locally to finance, national security. And because that's what we're talking about here. And that's works both ways and could, in essence, change the nature of flows we've seen going west and west and west again for decades into dollar assets and into the dollar, now reversing one after the other. Maybe Asia is coming last. Maybe on that notion of flow, we've seen as well that funds, and particularly you talking about local investors and the massive current account, you would expect the currency to be strong in such context, right? You got a big balance, and you got locals that are quite keen to gradually invest more domestically. Yet the currencies remain strong lately. Why is that? I mean, when you dig into the mechanics behind, then it's about the other actor in the equation, is the foreign investor that had invested in Asian stocks. And particularly if you take the example of Korea, these foreign funds that had bought these stocks technically had to sell Korean assets, and they of course sold the Korean one with it, adding pressure to the won. And the technical reasons is fairly mechanical, fairly straightforward, because of the fantastic performance of the Samsung and SK Hynix, the big caps in the index that exceeded the cap level they had in their own passive management. They had to take that way down as passive managers through the index rebalancing process, and in doing so, they had to sell one for big amounts. Now, practically, this, as soon as the performance of these assets normalize, I'm not saying go down, but just stop overshooting, then that technical pressure stops, and it's probably already over, because the last 4 weeks have been a lot more stable in terms of price action. So I mean, my best guess would be that soon enough you're going to see that pressure from foreign investors disappears, and you're going to see the power of this massive current account they've created, and gradually that appetite of local investors for their own assets, and that should take all these currencies up more mechanically, right?
Yeah, probably. I mean, there are a few other reasons why we think the tide may be turning for Asian, currencies. Is that also that because of this strong impulse in the domestic growth, as I said, the central banks are biased to be hawkish and hike rates. Why? The Fed, we know, is at the end of this, at the first phase of the loosening cycle. It's in the wait and see mode at the moment for the moment. So what's going to happen is that the interest rate differential between those currencies and the dollar,
which is the cost of hedging, right?
The cost of hedging. So basically, people used to sell those currencies because it was so cheap to sell the currencies. So even though you were investing locally,
so expensive to hedge the dollar risk. Yeah,
exactly. So, and it was a way to, for example, at H2O, we've always been, using the Asian currencies as a short to finance other carried position in the portfolio in Latin America or in Central Europe, because it was a way. First, those currencies were, structurally cheap because the countries and the authorities were leaning against appreciation, and second, the carry was very cheap, so it was a good risk reward to short them. But then, because of the change in bias for the central banks, of course, this will change the interest rate differential for locals and for investor for an investor
cost
to
of
invest
hedging a lot cheaper.
Exactly. So that's important, because interest differential in the currency flow.
We know actually institutions at a certain cost of hedging, when it falls below a given threshold, and we're not far from these levels today, they tend to a lot more mechanically hedge their dollars. Until now, they had a huge incentive to keep their dollars. Now that is changing now with much more hawkish central banks out there in Asia. So that means, in our portfolios, if we are to look at what we like and don't like in the region, we've been fairly positive on equities in the region for now a year or so. That worked pretty well, and we remain constructive on these assets for all the macro reasons we described. Now on FX, that's new. It seems that on the back of what's going on equities, FX is now turning as well, and should now, instead of being a drag on equity performance, will come as a support, and that tells us maybe to go overweight these currencies. So far, it's been for a long time. Maybe too many years, a long yen position we had in our portfolios. Now it's being supplemented with positions in the Korean won, in the Taiwanese dollar, even in the Australian dollar, which is part of the big Asia as well in some portfolios. So that is a big basket of currencies now we do favor in our portfolios. And that, as you said, it's sort of the first time we really go long.
Yeah, if I may add, there is, I think, another positive point for this currency, which is worth mentioning. The yen position we've had for a long time, which is what was also a value position. The fact that the BOJ was about to in a rising cycle for rates, but it was also defensive. Those currencies in North Asia are also cyclical and positive. It's a way to benefit from this global cycle in a different way through the saver and not the dater, which is the US, the saver. So you are, I would say, on the right side of the equation with the creditor rather than data. And in those moments where we start seeing some sign of questioning about the stability of the cycle, I think it's important. The second thing here is that we think that it's more multi-scenario from that standpoint. Why? Because most of the dollars, as I mentioned, are in private hands, i.e. pension funds, corporate, households sometimes, that old dollar account. So from that standpoint, you could argue that what happened is the AI cycle is softening, suddenly or declining a bit, and those currencies and those economies would be suffering from that. True. But then you would have a situation where those money, which is invested in the US, would be returning to their local markets in Korea and Taiwan, as Japan has been working for years and years. So here we think that it's more multi-scenario than just pure cyclical investment.
If I follow you on this, these currencies that have been historically more like offensive currencies, more risk-on currencies, have now gained some safe haven capabilities, if I may say, basically because they hold so much of these US assets. If there's a shock out there, which, as we discussed, may happen with the current massive AI investment boom, then that would trigger repatriation, and that would make these currencies stronger, not weaker like in the past. And in that sense, that's another argument, right? In this list of supportive argument for holding a position in those currencies. Maybe we may say that the dollar is gradually being replaced progressively as a safe haven, as a currency, defensive currencies, progressively being replaced by Asian currencies, possibly. So on that note, thank you, Thomas, for that long and interesting discussion. Thank you all for listening to this Think Macro episode of Think Macro, and speak soon on another episode.
Thank you, Vincent.
Thank you, Thomas.